Hey everybody, it's Pete. Welcome to Stock Trading Pro. Thank you so much for being here with me. And more importantly, Stocks for Breakfast, which is Monday. We get everything kicked off for the week. We got a ton of stuff that I want to introduce you to today. Probably the biggest picture thing is about how to trade the current price action. We're going to talk about earnings. We're going to talk about the most recent price action. We're going to talk about the sectors and the industries that are popping. Give you a little bit of a sneak peek behind what I do in the daily ticker every day. But I want to start out with something really important. Obviously, we got the big library in the back, and everybody asks what's back there. I pulled something out of my something I've owned for a long time. It's one that I beat up pretty good, and it's relevant to the current stock market price action, which is a little bit more, I would say, short-term in nature, just specifically because of the kind of back and forth that we have. And there's two different kinds of price action that are really important. One of them is called harmony, and one of them is called conflict. And I'm also going to show you how that looks on the charts, and then more importantly, how that plays into the proper share size and how that plays into the proper profit expectations. We spent a lot of time on our swing trade game plan session, which we have every Saturday afternoon, discussing the current market conditions and what that looks like for what you should be looking for your initial position size, the right profit targets, and then what kind of profit maximizer you should actually be putting into that idea, which, actually that brings me up to something. I want to show you this because we obviously spend a lot of time on these videos talking about order flow stacking and the whole process behind order flow stacking. So I actually created a training that I'd like to give you. You can actually grab it below. I just want to show you what it looks like. If you click onto this here, you'll actually see that we spend a massive amount of time talking about why chart reading is not trading. And that's really the biggest thing we want to get across. So if you are interested in going into a little bit more of a deep dive of exactly why order flow stacking is different, why I believe it's superior, and even taking that a step further, why it is probably the easiest way to read price action and produce some of those bigger gains in the current market, really in any market condition, click the link below in the video. It's free training. All you got to do is opt in and the video pops up on the other side and you can start watching it right away. And by the way, I just want to give you a heads up. Make sure that you have a pen when you're watching that video because I really deliver the goods. It's a 50-minute training walking you through from start to finish what order flow stacking is. We talk about the optimal entry. We talk about tape reading. We talk about the profit maximizer in there as well. But more importantly, I show you why they are different from traditional chart reading and why you kind of elevate yourself beyond everybody who's just looking for chart patterns. The other thing I want to talk about is this book, but I have to pull this up on the screen first. So just give me 1 second. Okay, so obviously everything that we talk about here is for educational purposes, but I want to help you make better decisions. So that kind of plays into what we're looking at right now. So if you take a look at this book by Richard Wyckoff, this is actually one of the most popular books that I have on my shelf, and I'm going to tell you why. What they did way back in the day, this book probably 100 years ago, this is actually segments from the magazine and newspaper articles that he used to write back in the day about the market. And obviously they didn't have the benefit of all the computer-driven stuff that we have today. This is really about pure price action and volume. And that's really what I want to show you right now. I really want to get into that. I'm going to start out with the S&P 500. Before we're going to get into the daily ticker and breaking everything down here for you today as well. Don't worry about that. We're going to get to that in a minute. But I first want to set the tone for the big picture, what I'm talking about when I mean harmony versus conflict. So we're going to actually dive in right over here. And we're going to start out with the market, okay? Heading into the new week, we have what's known as conflict on the charts. 2 months of selling versus 2 weeks of buying versus 2 days of selling. So if we kind of give that a picture, 2 months of selling, basically a week and a half of buying, which again, if you were listening last week, we called that bottom there basically for what I'm going to show you in just a second, and then 2 days of selling. So here's the part that a lot of traders just don't understand. When you are taking your wallet out and you are going to put new money into a trade, you have to know the quality of that idea And actually, we just got asked this question by somebody in our coaching inside of our new website in a new forum just recently, asking about how do I know what kind of position size to put into a trade? By a mile, nothing is even close. The biggest mistake that people make is thinking that every single trade, every single stock that they buy is the same deal. No way in the world is every trade the same deal. And actually, we got John Bates here with us today. Good morning, John. Always a pleasure to see you. I got your email, by the way. I apologize for not getting back to you soon. I've got a ton of stuff going on right now. But anyway, here's the thing I want to talk about. When we are talking about harmony versus conflict, I think everybody probably watching this understands multiple time frame analysis. We kind of have a little bit of a twist on that when we talk about order flow stacking. Two different ways of doing it that's just much deeper than saying multiple time frame analysis. But even if you just understand multiple time frame analysis, and let's say that we look at the big picture, which is Dow theory, which is the longer term trend, which is most people use the 200 period moving average. Then you kind of work your way in a little bit more, which they call the intermediate term trend, which is the 50 period moving average. And then all the way down, which is what they spend a lot of time on in this book talking about, which is the short-term active traders environment. So if we kind of take a look at that on the charts and we pop in the 50 period moving average, pop in the 20 period moving average, and then actually, you know what, let's actually put the 200 in there just for the sake of this conversation. You can actually see if we kind of zoom out here that we have mixed picture. Price action closed below, right at the 20, below the 50, but above the 200. Now, that's what we call conflict. Okay. Now, this is very important. And I'd really like for you to write this down. Hey, Rick, good morning. Good morning, Chris. Thanks so much for being here with us. So here's the big thing I want you to write down. You need to know what perfect looks like in order to understand what kind of environment you're in at that moment. But more importantly, and I want to keep bringing it back to this, which is how much money should we be putting into the next deal? If you understand what perfect looks like, and I'll just give you a high level, visualization of that. So if we kind of go back into, let's take Amgen as an example, which is kind of really punching higher. Everything is kind of in the right direction. We got some really good, clean follow through off of this simple breakout, which we actually called out last week if you were here with us. Everything is pointing in the right direction. Now, we would like to see a little bit better slope on the 200 period moving average. We'd like to see that start heading higher. But when you compare everything moving in the right direction versus where very watched metrics such as the S&P 500 or small cap stocks, which are actually all in bearish environment right now, we are in conflict. When we are in conflict, that means that you need to now step up and say, how long do I plan to hold this trade? Am I looking to hold it over the next 3 days? Am I looking to hold it over the next month? Or am I looking to, maybe between earnings seasons, which we're actually going to talk about Tesla in just a second and break down all the earnings that are coming out this week, which, as you saw from the picture, that fancy picture that we put out there this morning, when you start to really kind of map out what you're doing as the week starts to unfold, this is the kind of stuff that we're looking at. And earnings season is going to be the next big thing that we're going to be relying on. Now, what does that mean? What does that mean that earnings season should have most of our attention right now? Well, we just established the fact that the S&P 500, the SPY ETF, is in conflict. All of those timeframes, all of the different investors and traders and active swing traders are kind of duking it out right now in what we call price discovery. And price discovery is basically saying my buying pressure against your selling pressure, against the longer term selling pressure, against oil, against gold, against silver, all of those things going on at this point. There's supply and demand are kind of duking it out for the next big push. So what does that mean? What does that actually mean for trading this week? We're going to kind of compartmentalize it because nobody can predict the future. Our job is to put all of these pieces into one nice, neat little box and say, what does that mean right now? What does that mean for the trading decisions I need to make right now? What that means for me, because we have conflict, it means that I'm going to be a little bit more active And I'm going to be using what we call the momentum profit maximizer. Now, again, if you happen to see the beginning of the video, click down into the description. You can watch that 50-minute training and you'll get a lot more detail on everything I'm talking about. But there's two kinds of profit maximizer systems. One of them is when we're in harmony, which means everything is pointing in the same direction. And I just showed you one example. I'm going to show you another one. The second kind is conflict. Harmony means we're expecting better follow-through. Harmony means that right now, with all the information we have at that moment, it looks pretty darn good, and we're going to expect it to continue until we see, by reading the tape, that it has changed. So again, if you get into the full picture here, order flow is the dominant side of the market. It's where we're shadowing the institutions who make up roughly 70 to 80% of the entire market. So we're just shadowing them in and out of sectors and stocks and industries. But then reading the tape is telling us when that picture is potentially changing and then when it actually has changed. So when you put those two beginning pieces together, order flow stacking and tape reading, that's the edge. That tells you whether or not you should be involved at all. But what most people want to do is go right to the second half of the trading strategy, which is tell me where to get in and tell me where to book a profit. But the problem is, if you don't do the first part, the second part is kind of meaningless because you have no idea what kind of profits to go after. So I'm going to walk you through. I'm going to give you visuals because I think this is really important, right? So if we kind of work our way over into what that means. So if that has your head spinning, be good, because it's incredibly important to set the tone for the right type of expectation before you choose to accept risk. So all I want to make sure is that you get across right now. And again, I'm going to keep bringing my wallet out because it's that important, right? Before you choose to put your hard-earned money on the line, you have to say to yourself, based on what's going on in the market right now, and I'm going to show you how to do that in a heartbeat, based on what's going on in the market right now, what kind of profits are realistic? And then when you say X profits are realistic, and I want to pull that all the way back and make it really simple. Should we be trading for quicker profits because there's some pockets of opportunity that are obvious? And for us, that means we might go into sectors that might be obvious and then go even one layer deeper, which would be industry groups. I'm going to show you that in a second as well. Once you decide what kind of profits are on the table, then that's going to tell you how much money to put into the deal and how to manage the winners. Think about that for a second. We get so many people reaching out to us in our community for the first time saying, I know what to look at, but I can't make money. Raise your hand if that's you, right? I think everybody's experienced that, including me. That's why I have all the books. I kept looking for another book to give me the answer. But let's go back to what we're talking about. Harmony versus conflict is going to be trend profit maximizer when everything looks great. Conflict would be momentum profit maximizer, which means there's some opportunity, but not perfect. So when you know what perfect looks like, every time you move away from perfect, but you start taking out, well, that's not there, the sector's not there, the industry's not there, the volume's not there. You start to put those and you take them out, you move away, you put a little bit less in, if you even want to be in the trade in the first place. I want to say, hey, Boyan, good morning. How are you? Great to see you here today. So let's kind of move over and let's actually take a look at what that means, okay? For obvious reasons, oil is getting a ton of attention right now, but it's incredibly difficult to have conviction in those ideas. So you see how we keep bringing it back to conviction? Everything we do in trading is about stacking all of those pieces together to have conviction if we should be getting involved in the first place. And if we do, what does that mean for harmony versus conflict? All right. So that for me means much shorter term plays right now. Okay. Actually play. A trade on the commodity side, actually, that a lot of people aren't really paying attention to right now, which is pretty interesting. Just write this down. Gold and silver, something to be paying attention to. We were watching PAAS and Newmont and AEM last week. Make sure you keep an eye on those as well. So just give you I'll put those into the screen here as well. So we're starting to see that they're coming off the mat. Not quite yet. Let me actually get these guys off the screen here. They can be a little bit, these moving averages can be a little bit intrusive. So you can start to see, not quite yet, but as things start to get a little bit more chaotic, people start to work their way over to this particular area, right? That's kind of a side note. These are more tracking journal things. So let's keep going through, right? Yes, we're actually having a flight to quality. Who would have guessed? When's the last time we talked about that? We really didn't for a long time. And this is why. For the last few years, probably the last 15 years, the same type of trade has been running to stocks such as Apple and JP Morgan because of their balance sheets. Okay. But that's changed a bit as we're no longer in what they call ZIRP, zero interest rate policy environment. So here's the big thing. Now we're starting to set up how we plan to trade heading into this week. The big questions heading into this week. Can banks find new buyers after the bullish gaps that close near the low? So let's specifically stick with JP Morgan. Obviously, a gigantic move in JP Morgan last week, got all the way up to this resistance and pulled back. You can see it's actually coming back. So one thing we're really going to be looking for is, can buyers get back above this level where the gap happened? That's in our universe, that earnings gap open price is a big level. Now, I want to give you a visualization because obviously there's all of this price action that happened on Friday. There's two different ways of looking at this. You have all the price action that happened on Friday. So we're already above that level where it opened, but we still have to fight back here. So Nike is going to be a good example for you to keep an eye on, because this is actually where Nike had the earnings gap. And look, it took us almost 2 weeks to claw back above that level. So now this is what that means to me. JP Morgan, while it might be right now above the earnings gap from Friday, the opening price on Friday, that's important. And I'm going to start to pay attention to that and look for an entry. But it's still got a long ways to go to get out of Friday's price action in general. If you take a look at the Nike trade, where it gapped up all the way up here, what we are looking for is follow-up buyers. So in other words, let's say Al was the big buyer that pushed Nike all the way up after that, after the earnings announcement came up. And he's like, man, I can't wait to get involved. It's got enough. He pushes it up there. But we don't have anybody coming back after that. So essentially what we're talking about earnings season, we're looking for follow-through in the direction of that volatility. So we have, again, reading the tape, right? Reading the tape is we have that line in the sand. It pushes up and pauses. Now, you saw it too that did not hold, but I want to give you a visualization of how powerful this could be if done properly. So I'm going to give you another example. We're going to hop over to this stock, which you now have a really good visualization of what we're looking for. So you can actually see Jabil came out, and this is, you could have got all of this because it was a pre-market announcement, plenty of time, and you can see this $30-something move just by leaning on the earnings after the fact, which is a really, really big part of trading. And I don't teach trading into earnings, and I don't do it myself, so obviously I wouldn't teach it. What we look at is we wait for the earnings catalyst to come out, and then we look for follow-up buyers. So let's say that if Al is the buyer that pushed it all the way up, and let's say Harry is like, nope, not yet. And then a week later, he's like, okay, I read the financials a little bit more, and now they start to dip their toes in. And if we go back to Nike, that slow accumulation of buying pressure has now got it back above this significant reference point, which now is kind of validating the break of this longer term move, right? So let's continue to break down the week because this is really important. So can the banks find new buyers after the bullish gaps? So that's actually what I just showed you, right? It's always important to have that visualization. Can Elon Musk and Tesla, which actually let's kind of hop on over there into earnings coming out this week. Let's get a full visualization of what's going on, and we'll put earnings for the week in here. So obviously Schwab today, it looks like, let me go back. I don't know why that happened. Let me go back here. Schwab came out. It's pre-market today. We'll take a look at those numbers. Doesn't look like it came out yet. But tomorrow, scheduled for tomorrow, more banks and more healthcare. If you remember, we talked about healthcare. Let's actually get a little bit ahead of ourselves here. We talked about healthcare over here. Healthcare is starting to perk up. It's second to energy right now with the amount of stocks that show stacked order flow. So let's just take a second to really think about what that means. It's one thing for the sectors to be above moving averages or to be showing bullish stacked order flow. But we want to take that a little bit deeper. Again, I'm going to keep going back to this. If you're going to take your wallet out, you want to have conviction. It's one thing to say the sector is strong. It's another thing to say how many stocks are making up that number. So we all know the FANG stocks right now and how much of a hold on the market where they have a monster percentage of, let's say, the S&P 500, where just those 7 stocks could be really strong and making the market look a lot stronger than it actually is. but let's say the other 493 stocks in the S&P 500 are not. So it can be a little deceiving. So that's why we want to go a little bit deeper into when we say a sector is strong and perking up. And again, I promised I'm going to show you that in a second. We need to know how many. Was it 2 stocks that dominate, or was it a bigger list where now what we call stacked order flow is kind of now infecting the rest of the sector, and it's kind of digging roots, and that will give us a little bit more conviction. So essentially what that means is if we take a look at the stocks that show stacked order flow for last week, energy obviously at the top of the list, but healthcare kind of working its way up. So if we work our way into looking at the S&P 500 from last week, you can start to see some pockets of opportunity in healthcare, and especially in healthcare plans that are starting to break out. So if we kind of work our way into that just a little bit deeper, right? And we kind of work our way into, let's say we go over there and pull up healthcare, and we start to sort these bad boys by what they did last week, you can see very, very clearly how there's some opportunity on breakouts. Amgen broke out. United Healthcare broke out. J&J, not quite yet, but it is threatening to break that downtrend. Obviously, MRTX, that big trade that we had a couple of weeks ago. So now you understand where to start to pay attention, but there's also some more in that group if you go a little bit deeper. There's obviously 13 stocks that meet that criteria. We just ran a really quick scan based on last week. So if we kind of go back to the S&P 500, and I want to go back to what I said before about harmony versus conflict, can we look at the market for the last week and say, my gosh, I can't wait to be a buyer this week? Very hard to say that right now. There's purple on the screen, it's some red and some green, but not really looking amazing, right? So that means we have conflict, which would lower our initial position size. And that's really a big thing that I want to get across here. And I'm going to keep going through the newsletter here to give you a really good feel for what's going on. So I'm making a very clear distinction here when I'm saying initial position size and initial profit target. We're not putting a limit on what a stock can do. What we are doing is choosing how we want to take the initial risk and what is the likely initial reward at that moment. And I'm going to show you Apple right now because it's a really interesting way of describing it. So if we take a look at Apple, which kind of popped a little bit there for a couple of weeks, you can start to see that Apple, while it started to push up, had 1, 2, 3, 4, 5, 6, 7 days in a row where we saw higher lows. We'll actually kind of take that one out, but it closed strong again, right? So essentially what we're talking about here is we might have had an initial target on a weaker stock that was rallying and have maybe a tighter profit target. And once it got up to that level, then we continue to trail it higher until the stock tells us, no, I'm done. So that's kind of like a definition or visual of what a momentum profit maximizer is. Now I want to give you some visuals. Okay. I think it's very important. So if we continue with what we're talking about here, before we get into sector rotation, we're going to head right back up to the market, talking about conviction, right? So can the banks find new buyers? We just showed you exactly what that means. Can Tesla pull a rabbit out of its hat? Earnings are coming out. So you can see it's starting to roll over a little bit. Now, here's the thing with Tesla, and this is incredibly, incredibly important, especially for those of you that own a business, right? There's a lot of people really devoted to Tesla. And you can see here now a couple that really hasn't done anything going all the way back to June. So we're talking about successive earnings announcements. Now, the big thing with Tesla, and a lot of stocks, let's say like the streaming services, you pay attention to subscriber growth, right? Netflix and Tesla and those kind of companies. Netflix and Disney. With Tesla, the big conversation has always been around the amount of cars they delivered. And a lot of the other electric vehicle stocks, that's been the metric, right? And that's interesting. It's exciting. We're selling more cars, right? But if you're not making more money by selling more cars, you're going in the wrong direction. So what we need to pay attention to with Tesla and earnings, which are scheduled to come out, I believe, let's just take a look at that. I believe it's Wednesday. Okay, so Wednesday after hours, right? So what we need to pay attention to when Netflix, I keep saying Netflix, Tesla reports, margins are the big thing. Consecutive earnings, 2 earnings seasons in a row, decreasing margins was the conversation. So that's why I kind of put in there, can he pull another rabbit out of the hat? Because Elon Musk needs to report something more positive from a margin perspective. If they don't, and margins continue to decrease as competition continues to come in, boy, they got good first mover advantage. But if those margins keep going down, look out below. I don't want it to happen. We're just talking, analytically here, but we need to know what we're looking for before it happens. Remember, when you know what you're looking for, you're never lost. And that's a really big part of trading. So now we're kind of extending that into earnings. So what we're going to do now is we're going to get into the sector rotation, industry groups, and some plays that we're mapping out for this week. Okay. So if we kind of work our way through, I just want to touch on, here's the last week, 4 weeks of trading. Obviously, energy was perked up a little bit, but here's Friday. We didn't really have an awesome week of trading, very, very neutral. So that's kind of where we keep talking about conflict, right? So if we work our way down, if those answers come back, yes, to move to the upside would be unexpected, which means it has the potential to be fast and furious. So if banks come out and start to see buyers, if Tesla and Netflix and those other stocks start to show positive surprises, we could have a fast and furious move to the upside. But we need to plan the other side of the market. That's what good traders do. If the answer comes back, no. Now, I want to give you something very subtle here. This is what winning traders do, and this is what we talk about all day, every day in the community. If you want to be a profitably, consistently profitable trader where your income from the market is predictable, you need to learn if this happens, then I plan to do this. If this happens, then I plan to do this. If the answer comes back no, and we stick to our proven metrics in the S&P 500, which again, if you're a regular viewer of the channel, I want to give you a little bit of lesson on this as well. And by the way, I hope you are a regular viewer of the channel. If we're doing a good job, please do me a favor, give us a thumbs up and make sure you hit that subscribe button so you get future videos. What I'm talking about now with our proven metric in the SPY ETF, the S&P 500, is bearish moves in the S&P 500. And this kind of mapped itself out in 2022 bear market. Bearish moves in the SPY ETF are 30 points. That's what we call the average true move on the bearish side in the SPY ETF. If that is indeed the case, and we do not get these better than expected or better hoped for earnings reports, now we have to look to where is the downside likely going to end up moving for the next move. Now, why is this important? Number one is you have a little bit more conviction in the side of the market that's unfolding. Number two, you will have conviction to hold those good short sales or puts if you bought puts longer, because that 30-point move in the S&P 500 is pretty rock solid, and we kind of leaned on that all of last year, and it just played out 2 weeks ago. So I want to show you. It's not talking about 22 anymore. I'm talking about now, which is this move. So if we kind of take a look at this move from here to here is roughly 30 points, almost 30 points right on the dot, and you can see we actually stopped right there. Now, if this move here, which kind of topped out on Thursday, does indeed prove to be the next bearish move to the downside, the next support levels all the way down here at 406 in the S&P. So we got kind of both sides of the market completely mapped out. Now, what's really important about that is think about what we're doing. We're putting pieces into the puzzle to say, if this happens, this is going to be my conviction and my direction. If this happens, this is what I plan to do in the other direction. Now, if you don't like short selling, you don't understand the bear side of the market, you could buy puts, which is easier to think about than short selling straight up stocks. But here's another important thing. And again, it all comes back to my main thing is protect your capital. That's the job number one. If you don't like the other side of the market and the market is going down and it's validated that it's going down and you don't understand it, you don't want to do it, stay away. You don't have to get involved. If it's, God forbid, you try and pick a bottom, don't do that. That's not good trading. Maybe move up your trailing stop losses, maybe trim a little bit off of bullish positions, or maybe hedge those bullish positions if you want to hold them, where you buy puts and as it's going down, the puts will make money and you're holding on and you're kind of offsetting the losses on those longer term positions. So it's very important to know those two things. So if we kind of keep moving down to really give you some kind of perspective, this price action is excellent for reading the tape, but for longer term positions. Now, going back to what we talked about at the beginning of the call, Dow theory, 200 period moving average 50 versus 20. at least for the next 3 months, I'll be leaning on the earnings catalyst while the big picture sorts itself out. So sorting itself out is kind of what we just walked through. All right. Sector rotation. Very interesting trading that unfolded last week. By the time the numbers are all said and done, it looked like an ugly week of trading. But quite frankly, last week was amazing to trade. It didn't matter if you were day trading, swing trading, buying stocks, or short selling. There was something for everyone. The only challenge you might have had the last 2 weeks was being patient to wait for either the news or the economic data that got announced on Wednesday and Thursday, and then earnings started on Friday to pounce on those opportunities. So that's kind of what we're looking at right now is we know the earnings that are scheduled to come out this week, and now we're going to be watching to see, do last week's earnings catch a bid again, or do sellers continue to come in and say, no, the guidance we got wasn't good? And we just talked about how to trade that. Now with the earnings coming out going forward, we had some healthcare earnings last week. We saw those big moves to the upside. How do we play those? And actually, I want to show you another one that actually reported last week that was pretty good. So here's the breakdown. And you know what I'm going to do? I'm going to actually put a link to this as well as the video training I just gave you before. I'm going to put a link to this below the description as well, so you can actually grab your copy of this also. All right. So obviously, some of the stuff that's packing a punch right now is industrial stocks, energy and industrial. Obviously, for obvious reasons, the travesty that's going on right now in the Middle East. But earnings are coming out. So what we see now in Lockheed Martin, this big move against the short-term order flow has now held the gap. So right there is the gap, but we have earnings coming out and we have resistance coming up. So a little bit more shorter-term play like we've been talking about, right? Same thing here with General Dynamics. Earnings coming out, holding the bid. Now you can actually see, if you could visualize this gap and we held that price and we stayed above this resistance, man, that was an interesting play over the last 5 to 7 days. Surprising sector to focus on is healthcare. Amgen and Cigna, both examples of recent order flow in the sector. Look at last week. If you couldn't find something last week, this is where it's been hiding. It's been hiding in healthcare. Now, Amgen actually finally punched up to that big resistance level we watched. We're looking to see if we could pop through there. Cardinal Health, look at this. Can't find something to do? You got to learn to run these scans every day. You got to learn to find the opportunity every day so that you're in the right stocks at the right moment. And then you actually want to break this down even more to start to see where has it been consolidating. So if we kind of work our way over here, you can start to see where heavy buying or selling is actually happening. And you can see healthcare, 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 healthcare. There's clues. You're looking for clues. You're not looking for answers. That's a big thing that a lot of people make a mistake with. So now this is an interesting one, right? If you were in my office right now and we were trading together, I'd be like, this is fantastic, but I'd be selling a higher opening with all of this resistance and this move very far beyond the optimal entry. And this is where a lot of traders get into trouble by buying too late, not recognizing what the optimal entry is. Okay. All right. I would say it's mildly shocking that technology has held the bullish relative strength, despite the Fed having no plans to give them a break and lower interest rates. So what does that mean? Where do we go? Well, look at Zscaler breaking out, perfectly pulling back to the support level. I'm going to be watching that one this week. We also have another one here. As we said, Apple, longer term move to the downside, shorter term move to the upside, and a shorter term bullish rally. Conflict. You can start to see this right now. Bearish, bullish, conflict, lower the initial position size. All right. And you can actually see here and get a little bit of a bigger picture as far as what's going on in the overall tone, right? So you can see the last 4 weeks sector rotation show us bearish to neutral with a short covering rally mixed in. This is where tape reading skills come into play by reading the recent price action and making that important distinction for where that fits into the bigger picture. So we just talked about that. That's conflict. You can see that they're all over the place. We have big push down, a big rally. But we also want to understand what harmony looks like. Harmony is when everything is on the same page. Now, when you can't find ideas, again, you got to do this kind of work every single day to understand where the opportunities are. And this is what, obviously, this is what I do for our community every day, where the money is hiding. And it's not really hiding. It's just got to go and spend that extra 5 minutes and dig it out, right? So we talked about a lot of stuff today, but I really hope the biggest thing you take out of today is this. Before you put your money into an idea, you have to know how is the market unfolding? What kind of edge do I have right now? And what does that mean for my initial money I'm going to put into the deal and the initial target I can expect? Now, if you don't understand what that means, it just basically means, am I going to put 100 shares in this deal, or am I going to put 500, or am I going to put 1,000? When you could learn to make that distinction, everything changes, because you're never guessing anymore. You're not going to be nervous anymore. You're not going to be hesitating anymore, and you're not going to doubt, because you're going to say, I know what's going on, and that means I should do this. And my gosh, that's an exciting place to be when you're trading, because now everything that you achieve in the market is up to you and not the market. We are simply just reading it instead of predicting. And that's a really fun place to be in the market. So obviously, I talked about a lot of high level stuff here today, got a little bit in the weeds and some other stuff. If you want to really go deep on this and learn a little bit more about how I do this, click that link in the below in the description. Just fill out your email and your phone number and get in there and watch that video. Take some really good notes and then come back here, ask more questions. I'd love to follow up with that. So I'll post the rest of this into the description below as well, so you can get a copy of this for yourself as well. So have an awesome week, everybody. I will speak to you soon. Thank you so much for joining me here today. I really, really appreciate it. Give us a thumbs up if we did good, and make sure you hit that subscribe button. Have an awesome week, everybody. I'll speak to you soon.